Federal Reserve is about to run a test, and the results of that test is going to tell us what comes next. All right, that's the topic of what we're going to dig into right now. They are going to perform a stress test. Let's take a look at this. If you can see on my screen right here, this Reuters article came out today. It says that U.S. banks are expected to have a clean bill of health after the Fed's stress test. So a stress test, sort of like if you need to get your heart checked out, you go to the doctor, they hook up a bunch of equipment to you, you run on a treadmill for a while to see how much stress your heart can handle, and then the doctor will tell you, okay, your heart's pretty strong, you can go play sports or something like that. Of course, if it's not very strong, then don't play sports, you can't take much stress. And the Federal Reserve is set to do the same thing with the U.S. banking sector, but why? What are they trying to determine what they can handle? Let's dig into this a little bit. So we can see here, it says large U.S. banks are optimistic they will receive a clean bill of health, like from your doctor, except for it's the Federal Reserve, from the Federal Reserve this week, freeing them up to distribute billions of dollars in excess capital to investors. So let's think about that for a second. I talk about this all the time, the Fed's printing money, the money printers, et cetera. That's not really how it works. We're in a debt-based monetary system, so the Federal Reserve gives reserves to the banks, the commercial banks, think Citibank, JP Morgan, Wells Fargo, et cetera. Then the banks create money into existence by doing loans. When you get a house, car, boat, RV loan, that money is created into an existence. Now, those banks can create as much money as the Fed tells them they can based off of their reserve requirements. And so what they're saying is, if they get this clean bill of health, like they expect to, then that will free them up to now distribute billions of dollars more in excess capital to investors. And so instead of having to hold this money, they can now send it back out to the investors that hold their stock, their equities, or they could go create more money into existence through debt. We can see here it says the central bank on Thursday will release the results of its annual bank stress test, which assess how much capital banks would need to withstand a severe economic downturn. Now, this isn't anything new. The annual exercise introduced following the 2007 to 2009 great financial crash. And so this isn't anything new. This is something that's done regularly because of the great financial crash that happened in 2008 or 2007 to 2009, where the banks basically collapsed. And so they had to go back and kind of retool what they consider those reserve requirements to be. And they're looking at that annually to see how much stress. Now, most analysts, myself, and what the banks expect is that they will pass this test okay. But I think there's something else going on with this test. So let's take a look at that. If we go here, you can see this chart I have pulled up on the screen right here. This is the European banks, and this is where the problem lies. Now, what we're looking at here is the purple line is the credit default swaps, and the orange line is the Euro High Yield Index. So what are we looking at here? So one of the best ways to look at where the markets are going is to study the bond industry. That's the debt. So most people look at the equities, the stocks, but really you want to look at the bonds or the debt. And so what's happening is nobody wants to buy the debt, the high yield debt. And because nobody wants to buy it, the yields that they have to pay are going higher and higher and higher. If no one will loan me money at 4%, I may have to pay 6% or 8% or 10% or 20% until finally somebody's willing to loan me money at that price. And since nobody wants to buy the high yield debt, the interest rates that they have to pay is going up, as you can see in the orange line, skyrocketing. And you can see from just from June of 2021 through about February of 2022, it had been basically flat. And the purple line is the credit default swaps. And so when investors are afraid they may lose their position, they buy insurance against that. CDS, default swaps. It's like insurance. And you can see that the insurance has gone up, skyrocketing along with the rates or the yields that have to be paid. So what we can see is that in Europe, most investors see massive danger in the financial system. Now, if we take a look at this chart here, we can also see the red line here being the official interest rates from the United States, the Federal Reserve or the Fed funds rate. And we can see that they've been up and down. They've been sort of flatlined right here, and they've been steadily increasing, right? We talked about this last week. The Fed increased the Fed funds rate. But over in Europe, The European equivalent to the Federal Reserve, which is the ECB, the European Central Bank, has been keeping rates below zero, meaning negative, meaning instead of getting a rate of return for loaning them money, you actually pay them to borrow your money, which of course is insane. And you can see that they have a negative interest rate down here, while the Federal Reserve of the United States has been increasing rates. What does this mean? Well, if we look at this chart right here, it kind of shows the same thing, how all these other banks, we can see have higher rates, but the ECB is negative. But I think this is the chart that's pretty telling right here. This is the US dollar priced in euros. And what we can see is that from back here in September of 2001, the euro has been losing value to the dollar. And we can see from about 2012 here, the dollar has just been continuing to get stronger and stronger and stronger and stronger against the euro. And look at this last part that I've highlighted right here. So this last part that starts about a year ago, we can see that the dollar has gained over 20% over the euro. Now, what's important to understand about this, I think, is that I've been talking about this for a while. When it comes to Bitcoin, I'm going to bring Bitcoin up for a minute. A lot of people would say, well, the central banks will never allow Bitcoin to succeed because they'll never lose control or give up control over the currency, over the dollar. And I would agree. They're never going to give that up willingly. But if that's true, which I believe it is, then it would also make sense that the Federal Reserve of the United States, the New York Fed that creates the dollar, doesn't want to give up or lose control over currency to the ECB or the European Central Bank. And so there's a fight there. If the Federal Reserve continues to inflate and debase the dollar, it's going to lose value over the world and lose value to the euro, which could gain strength. And so about a year ago, it looks like the Fed, led by Jay Powell, decided to start increasing rates, which has started to drain liquidity out of the ECB. Now, the ECB isn't able to keep up. They're running negative rates, and they're not able to start raising rates. They said they would do it, and then last week announced an emergency meeting to probably have to pivot back on that. So could this stress test the Fed is running on the banks be a way to see if the banks, or I should say how much more rate increases the banks could handle, and if they're able to handle the stress of running a marathon, let's say, could the Fed continue to squeeze the banks, tighten the screws, we'll say, against the European banks to continue to bleed them out in a power struggle? Just like the central bankers don't want to lose control over the currency to Bitcoin, the Fed doesn't want to lose control over the currency to the European central banks. And this test, I think, will determine what the Fed can do to the ECB next. But what do you think? Leave me a comment down below. Let me know what you think. Of course, ask some questions. I'm trying to get engaged with you guys in the comments. Ask some questions. I'll expand on that stuff as well. Of course, if you're not subscribed to this channel, please do that real quick. Hit that subscribe button. Give me a thumbs up on this video if you like it. And if you don't like it, give me a thumbs down, but at least leave me a comment why. And that's what I got for you today, all right? To your success. I'm out. Since you've stayed to the end, I know you like this video, which means you're probably going to really like this video right here and this video right here. Since you've stayed to the end, I know you like this video, which means you're probably going to really like this video right here and this video right here.